Good morning, everybody, and welcome to the May edition of our economic and investment update. My name is David Baker. I'm Chief Investment Officer here at Mazars, for those of you who don't already know me, and I'm joined as ever by our Chief Economist, George Lagarias. So obviously, difficult times for markets presently, and difficult times indeed for central banks in this new sort of inflationary environment. So we'll spend a little bit of time talking about what's happened in markets year to date, and then George will give the economic context to that. And then hopefully we'll have a little bit of time at the end to go through some questions. Thank you to everybody who submitted questions in advance. Unsurprisingly, when things become a little bit more uncertain, we tend to get more questions, and indeed we've got quite a few questions pre-submitted. So thank you for those. If you do have a question that you think of during the webinar, please do pop it in the Q&A tab as opposed to the chat, and we will try to get through as many as possible. There are definite themes in the questions that we've had submitted before today. So thank you for those. So without further ado, let's get into it. Let's have a look at some context for how we find ourselves in the current position. And what we're looking at here is a chart of US money supply and a very, very obvious correlation with equity markets. So the light blue line being US equities, the S&P 500, and the dark blue line being US money supply M2. And that's really the ultimate output from monetary policy over the last 15 years, really. And if you've been on our webinars before, you'll have heard us talk about this a lot. Ultra low interest rates, quantitative easing, central banks needing to support very weakly growing economies, and therefore a lot of money being pumped into the financial system, not making its way into the real economy, really getting stuck into the financial system and having to find a home, and that home tending to be in equities, because everything else it really isn't paying you very much, certainly in terms of interest on cash or investment grade or indeed sovereign debt. So that's really the context for going into 2022, and of course the very significant complications of COVID, and then in March the war in Ukraine, and that's really the point, isn't it? This dislocation that we've had in the global economy, a dislocation of supply chains caused by COVID, and then the war in Ukraine having very significant impact on an awful lot of the commodities that are exported from that part of the world. So very much a change in global economies being percolated through markets with this significant downturn that we've seen year to date. So what does that downturn look like? Next chart just shows us on the left-hand side of that slide, 2022 in context of the last 20 years that we've had, and what we're looking at there is what you might call a traditional balanced portfolio: 60% equities, 40% bonds, how that's performed in each calendar year for the last 20 years. And I guess before looking at 2022, it's important that we do recognize that we have had a little bit of a free ride in markets, and some would argue a big free ride in markets, off the back of that loose monetary policy that I was just talking about. So if you look at the right-hand edge of the left-hand chart, of the best 5 years that we've had in the last 20, the last 3 years appear in that top 5. So 1920 and 2021 all appear in the top 5 years, despite it being very difficult from an economic perspective, and of course including the COVID period. So that obviously has reversed, and if you look at the left-hand side of that chart, 2022 is the second worst performing year, only surpassed by 2008. I'm seeing messages that people are finding the slides a little bit blurry. It looks fine to me. I know we've had this problem before. Hopefully it'll settle down. What we tend to find is that when we change the slides, they do start a little bit blurry, but hopefully that they come into focus. So apologies if you're experiencing that, but hopefully it'll settle down. So 2008 being worse than 2022, but of course it won't have escaped your notice that we're not even at the end of May in 2022, so certainly scope for this year to be worse than 2008, which, as we all recall, was a catastrophic year in the global financial crisis. So, tough times in markets, but not to be forgotten that this is off the back of very elevated valuations in a lot of asset classes that we can see from the last 3 years. And indiscriminate, if we go to the right hand side of this slide, we're not just talking about an equity sell-off, and where we've had sell-offs in the past few years, well, we have been talking mainly about an equity sell-off, and for those people with a balanced portfolio, assets being held up by your bonds. Not so this time. This is a pivotal change in the economy and in markets going into an inflationary environment. So not only are you seeing the S&P 500 down nearly 18% year to date, you're also seeing US Treasuries down 8%, bonds down 11%, and UK gilts down 10%. There is the one obvious outlier there, which is the FTSE 100. UK equities, simply by virtue of their makeup, energy stocks, utilities, etc., have not been as affected in 2022. And we've talked about this before. They've been undervalued for some years because we don't have the growthy stocks that have been in favour throughout the rest of the world. And I'll talk a little bit more about that in a couple of slides. So for UK based investors, and we did have an overweight in Q1 of this year in the UK, it's not nearly as been as bad as for most of the rest of the world. The one asset class that we haven't got on there, but it's probably worthy of mention, is gold. Gold in US dollar terms has been pretty flat, but for a UK investor holding that in sterling, you've made nearly 9% year to date in gold, and again, that is an overweight position that we have in the portfolio. So that's where we are year to date. Looks pretty ugly, but if we go to the next slide, it's worth reminding ourselves that the volatility is a natural part of how markets operate, and it's not unusual. So that chart there shows you the green dots are the lowest point, so point to point within any calendar year that equity markets have got. This is global equities in this instance. So on quite a few occasions, 2020, 2010, and I think 2009, you've seen markets fall significantly during the year, but actually ended the year in positive territory. So that is by no means a prediction as to what's going to happen this year, but it's just a little reminder that short-term volatility occurs in markets. Sometimes it can be a healthy correction, particularly if it is discriminating where it is finding itself in sectors across the markets. So although it is uncomfortable, sometimes it is just a natural cleansing of what's happening in certain parts of the market. So it's not our base case that we're going to rebound quite quickly from this downturn. That very much depends upon the path of inflation and central banks' response to that, but it is nonetheless a possibility, if indeed an outside possibility. So let's go to the next slide. I mentioned that the UK had performed well, and I also said that the sell-off had been discriminate, i.e. some sectors affected worse than others. And here you can see a chart which just plots the performance of growth stocks against value stocks. And what we mean by that is growth stocks tending to be companies that have big growth stories. So think about US tech, where they're constantly reinvesting their earnings into the business in anticipation anticipation of expanding and growing the company in the short, medium, and indeed long term. And contrast that with value stocks, which would tend to be those more mature companies where their earnings tend to be less recycled in the business and more returned to shareholders. And what you've seen over quite a few years, and particularly in 2020 when you had lockdowns and tech companies were very much in vogue, is that the growth stocks had massively outperformed value, and indeed they were sitting at some quite extreme valuations. Tesla was at around 1200 price to earnings ratio, which is frankly nonsensical. That's an extreme example, but people like Netflix and Amazon, in lockdown, as people change behaviors, they were very much the beneficiaries of that scenario. That dominance of growth over value has very much reversed in this year. And it was a change we made in the portfolios at our January investment committee to make that tilt away from away from growth and more to value, which has been playing out over recent months. So you can see that line starting to turn down at the start of this year as the more boring, utility, energy, consumer staple companies start to become much more popular, and the tech firms, particularly in the US, having sold off. So as ever, the headline index numbers only tell part of the story, and you need to get below the bonnet to see the real detail. What else has been going on? Well, the dollar has been very strong. If we look at the next chart, the dollar being the dark blue line, and again, this is simply year to date, the dollar being dominant, and the euro, the green line, and sterling, the light blue line. And this is simply a function of the fact, well, two main things. One, US monetary policy is certainly ahead of Europe, possibly a little bit ahead of the UK, and an expectation that interest rates are going to go up much more quickly in the US than they are in the UK, and certainly in Europe, and they might have an ultimately higher terminal rate. So you can be paid around 3% on the US 10-year Treasury compared to much lower numbers in Europe and the UK, and therefore that has attracted a lot of demand for the US dollar. Then you've got the simple fact of geography that the US is somewhat insulated against the situation in Ukraine, and particularly it doesn't have that dependence for agricultural commodities or indeed oil. It's pretty self-sufficient in both those two regards. So probably a tendency for economists and traders to think that the US is in a slightly stronger position, certainly, than Europe. And then, of course, finally, in times of stress, the US dollar tends to be a safe haven asset. That normally goes hand in hand with the Japanese yen, much less so this time. I think investors are losing patience with Japan and the amount of debt that it is carrying. So certainly the last few quarters, the US dollar has been the dominant currency. We made a change in April to have a little bit more exposure to that. We get the feeling that's probably run its course a little bit. The European Central Bank now starting to talk more about a pivot in its monetary policy. So perhaps that US dominance in currency terms might have run its course. It's not great for imports for the US economy, or sorry, let me rephrase, it's not great for exports in the US economy if you've got too strong a currency. So value performing over growth, US dollar extremely strong. So, where does that leave us? We've spoken a lot over previous webinars about everything being expensive. And if we just flick on to the next chart, please, Harry, thank you. We're now seeing things being far less expensive than they were, which sort of seems obvious. Everything's sold off, so it's not as expensive as it used to be. But the question therefore becomes, well, when is the point at which being less expensive becomes an opportunity to go back into the markets, and that is the conundrum that all investors face. And I'll come back to that in a second, but just to look through the numbers, on the right-hand side are the equities, and everything against its 5-year average looking, a lot cheaper. Now, you may well say, well, the average over the last 5 years has been very expensive, and that is certainly true. But nonetheless, for what it's worth, there are some companies, at least, if not in if not sectors or markets, but at least some companies that are now looking like reasonable value. On the left-hand side, that's bonds, investment grade, the light blue line, and your sort of high yield junk bonds, the dark blue line, paying you now around 2.6% for investment grade, 8% on high yield. Does that look good value stacked up against current inflation rates? Not particularly. But as I say, that is the question. Is inflation going to taper off as the base effects of energy price rises fall away? Or does inflation become embedded because people react to it in the corporate environment and in the labour market? And do you get a sort of spiralling effect where inflation begets inflation? That is the big unknown. So let's move on, please, Harry, because what we're really saying here is this downturn in markets has not been unexpected. We've spoken for many months, if not years, about how expensive markets are, both equities and bonds. But we've been, I wouldn't go as far to say relaxed or comfortable, but we've been reasonably comfortable because we've acknowledged the monetary policy environment that we've been in. When interest rates are so low, it really gives you no alternative but to remain in equities. And therefore, as long as that situation persisted, it was okay to be in equities and to be overweight, as we were up until about October of last year. Then obviously we had COVID. That gave you the supply side disruptions and led to inflationary forces. And then we had the whole conversation about, is this going to be temporary, or is it going to be inflation which hangs around and causes central banks to have to raise rates in order to fight that? What the answer to that would have been had we not had the situation in Ukraine, I think we will never know. But obviously we do have the very unfortunate situation in Ukraine, and that in and of itself has been extremely inflationary on the commodities side. Plus, we've still got lockdowns in China, and China is still the world's manufacturer. So these inflationary forces have not gone away, and listening to what's coming out of central banks, it's very clear that they are extremely concerned that this inflation is going to tip over into the labour market, which is very tight. A lot of people left the workforce, and we have very high employment rates. So pressures on wages there, and indeed pressures on companies to pass on their increase in input costs onto their customers. German producer price inflation is touching around 30% at the moment. So these inflationary pressures are not going away. And you can see that reflected on the left-hand side of this slide, where the market still thinks, at least in the short term, that interest rates are going to go higher than the Fed itself predicts. So therein lies the question: how long is inflation going to stick around, and what is the thing that actually will reverse central bank policy? On the right-hand side of that slide, a reasonably optimistic little dashed green line, which was the 2020 downturn, and obviously that was very peculiar in that it was COVID and it was lockdowns, and you had an awful lot of money thrown by not only central banks but also governments at the problem. That again is not our base case. The light blue line is the average of all bear markets post World War II, and you can see that they tend to be much more elongated, averaging around 20 months. That having been said, we do also know that there are a lot of algorithmic traders in markets, which means markets tend to move much more quickly than they have done in the past. And that in and of itself presents a challenge to investors when you're trying to assess, is it a good time to move tactically in and out of an asset class? You need to be prepared for the speed at which sentiment can turn and the speed in which markets can react to it. So that's where we are in terms of markets. George, let me hand to you and you can give a little bit more color to the economic background behind that.
Thank you, David. Okay, so trying to answer the big question, how long will all this last? Inflation started becoming a problem in around April last year, so about a year ago. And by the way, what I'm showing is a stylized cycle, but it's pretty well documented. That is usually how things go in terms of inflation, central bank tightening and loosening, economic growth and growth for risk assets. The central bank tightened policy, central banks tightened policy a few months thereafter, once they began to be convinced that inflation is not a passing phenomenon. And they were very right to think so. In the beginning, no one had seen inflation in 20 years. So this thing just popping up and saying, okay, fine, we have supply side inflation, but will this actually translate to wage growth pressures? That was a big unknown, and you cannot tighten policy unless you know that for certain. And obviously, as central banks tighten, the next thing that comes is the financial recession, even more so this time, because for the past 14 years, it was really central banks driving risk assets. So now that they're tightening, it makes sense that everything drops like a brick. This is where we are today. Now, this will continue. Central banks for the next few months will continue to be tight. And in the next few months, we're also going to see signs of more convincing and persistent economic recession, the stagflation part of the cycle. There's inflation, and then there is stagnation or low growth or negative growth. So this is where we're heading in the next few months. Unfortunately, it's not a step we can skip. As central banks tighten money supply, businesses lose some of their funding, costs go up, and that means less investment on people, on equipment, on plants, on all of that. After that, however, comes the critical point, the turning point, the point where the recession becomes more important than inflation. Now, this can happen one of three ways. One, inflation itself may subside, and it stands to reason that as it started rising last April, the year-on-year effect will start to subside. So basically, we're judging inflation, where prices were a year ago versus where they are today. If a year ago they were elevated already, this means that when we look at the numbers this or the next month, on a relative basis, because last year was elevated, it's not going to be so bad. In fact, if it wasn't for Ukraine, we could have seen inflation flattening out. Now, the X factor here is Ukraine and China and the effects on supply chains. So we're not really sure how this is going to play out or the timing of this. But the going assumption is that we will not see inflation flattening out in the next 1 or 2 months, as was the assumption before COVID. Rather, this could drag on for another 6 months to a year. We're talking about inflation as in elevated prices. You went to the supermarket, something cost £5, it now costs 6. This could remain elevated for the next year or two. What central banks are looking, though, is not that. They're looking at the rate of inflation. How quickly is inflation increasing, and this will be how they're going to make their decisions. Prices may remain elevated, but if they see the rate dropping, then they are likely to become more accommodative. Now, this will not happen probably in the next 6 or 8 months, and that's a Ukraine thing. Another way this can happen is if unemployment begins to rise. Now, normally when you have a recession, unemployment begins to rise, but employment conditions in the UK and the US and in Europe for that matter are very tight as we speak, i.e. there are more jobs than there are people doing them. So, it's a demographic issue, and that means that unemployment will remain tight. Yes, people will lose their jobs here and there, but it will not be a massive wave. Right now, pricing power is with workers, and businesses are struggling to find skilled people to fill in posts. So there is a lot of room to go before we say, oh, unemployment is rising. So that will probably not happen in the next 6 months either. The scenario where the turning point comes within the next 6 months is really the growth issue. The Fed and the Bank of England are making all sorts of assumptions about consumer behavior, but no model can predict what you and I are going to do in terms of consumption. Remember Brexit after the referendum, a lot of economists, and I have to say yours truly as well, were predicting a demand shock. People would be shocked after Brexit and they would not go out and spending. You know what? It never happened. And that was a valuable lesson. Consumers might continue to consume long after, rates have risen. Economists are also making assumptions about how people behave in inflationary times, i.e. they would rather buy something now than later when the prices are going to be higher. Not happening. People are increasing their savings as we speak. So, economists don't really know how people and consumers are going to behave. So they're going to slam the brakes on growth and then make some assumptions about how long it will take for growth to take a real hit. Hopefully it will help bring inflation down on the demand side. And from that point on, they can become more accommodative. But no one can really predict how fast slamming those brakes, how fast it will lead to a recession deep enough to cause central banks to rethink. Could it be 2 months to 3 months? Yes. Could it be a year from now? Also, yes. It depends on how consumers are going to react. Currently, the consensus thinking is that we should see enough demand pressures on demand by the end of this year, Q4 to the end of the year, for central banks to become a little bit more dovish, as they say, when it comes to interest rates. From then on, things take their path in the cycle. The central bank loosens, and until inflation rears its ugly head again, which could be anywhere between 2 years or the previous paradigm, which was 14 years, you could have again loose monetary conditions, which are great for markets and great for risk assets and those who hold portfolios, and good for economies as well. So timing exactly how this stops will probably depend on consumers, on you, whether you will go out and buy or whether you will increase your savings. This behavior cannot be predicted. I cannot stress that enough. That's why we have no idea exactly when this plays out, to the month. We believe that by the end of the year, the economic slowdown will have been substantial enough to, at the very least, merit a debate from central banks, whether they should be so aggressive or not. Next slide, please. Now, let's talk about the recession itself, because this is the economic section. What is causing the recession? Because central banks, hawkish central banks, hawkish, that's jargon, aggressive central banks are part of the problem, right? Because they increase the cost of capital, which means that investments are lower. Governments are also becoming a little bit more thrifty because they literally threw the kitchen sink at COVID-19, and now they don't have much more ammunition to fight this next crisis as well. And you can see how much Mr. Sunak is under pressure to come up with a more generous budget. And, I think it's a 50-50 call from where he is right now. I think it's all going towards some giveaways to help growth. But it's not just that. David said it previously. It's also the Chinese slowdown. China was responsible for 2/3 of global growth every year. And right now, some of our economists that we work with don't believe that it's growing by more than 2%. And to be honest, I'm on that camp. It's growing around there, or if it's growing at all. It's not just the lockdowns, by the way. China was the world's manufacturer, but it does not want its people working in factories for a couple of dollars an hour. It wants its people to have some of the goods that we and services we enjoy in the West. That means a transition from the manufacturing economy to the consumption economy, with great implications for inflation, for supply chain, for global growth, and what have you. A country of 1 billion plus changing direction and doing it very quickly, not in the course of one generation, but in the course of 1/3 of a generation, is a very, very difficult jump. Just historically speaking, when it made that jump the last time, in the 60s, from agriculture to manufacturing, nearly 50 people, an estimated of 50 million people died because of starvation. That's how abrupt it was, and the shock to growth. And then there is, of course, the Ukraine war, which is completely ruining supply chains. People are supply managers are being forced to redirect a lot of their their goods and services, and it's wreaking havoc, and it's making things a lot more expensive, and things are not being delivered. So we're back to where we were last April, post-pandemic. So all of these are causing growth to slow globally. And because the UK is one of the most open economies in the world and one of the most sensitive to global trade, a little bit more so to the UK as well, which on top of everything still has to contend with life post-Brexit, i.e. increased bureaucracy, and still the issue of the financial services sector to be resolved. Next slide, please. Now, we talked a lot about central banks. Again, central banks are probably going to determine everything. There are 7 more hikes, interest rate hikes priced in the US, and 5 in the UK. I think the markets might be a little bit too pessimistic. If growth slows down faster than expected, those rate hikes are going to be less, and the pressures on the economy less, which means the rebound could come sooner. Next slide, please. This is what we talked about, is supply chains. And now you can see exactly how much they are under pressure. The higher this index goes, the more pressure on supply chains. So we're back where we were in the back end of 2021, and things are only getting worse from here. That's why we're saying that the economic impact of this, we're beginning to see it, and it could be maybe a year and a half before we see some figures which are a lot more optimistic. If things go in their present course, if policy changes are made, obviously things will go back to normal a lot quicker. Next slide, please. Now, this is an interesting one because it's the financial conditions index. The higher this is, the tighter conditions, i.e. the more expensive capital is. Now, in the US, we talk a lot about aggressive tightening. This is the blue line, the thick blue line. But also we see this from the perspective of ultra liquidity. In the US, they really, pardon the expression, they really went to town with stimulus checks. So conditions were very, very liquid. And it did make sense that the Fed wanted to retract some of that liquidity from the economy. Again, the question is how much and how fast, and how will consumers react? Consumer reaction is the X factor here. Next slide. This is the other conundrum for economists. labor has returned to their jobs. So, most of the people that needed to return to their jobs, they already have. But wage growth in the US continues to persist. So that still means that there are fewer people doing the jobs than jobs available. And that chart is what's really scaring the Fed, the light blue line. If that begins to come down, and that is another part of this big equation, it's not just how will consumers react, but will they go to their boss and ask for a 10% raise to match inflation? In the last few years, they could not do that. It was a secular stagnation environment. Quite frankly, everybody was happy to have a job, and they would not go to they would not go to their bosses asking for a raise. Harry, can we go to the next slide and the one after that? And the one after that? And the other key indicator, of course, is consumer confidence. Now, you can see in the UK, we're pretty pessimistic versus the rest of the world. But interesting enough, in the US, consumer confidence is a little bit more resilient. I think this comes down to the culture. Anyway, it is, make no mistake, the index, the Michigan Consumer Index is near the lowest level it's been in the past decade or so. But still we're seeing an uptick. Things don't look so miserable. It's not a straight line down. So if consumers persist, then central banks will continue to persist with their hawkish tactics, which means that a more accommodative stance would come later in the year or maybe next year. If consumers start feeling a little bit more miserable, then this will come earlier. And by the way, is it bad news is good news? Yes, it is, because in the past 14 years, we've learned to rely on the lead of central banks to see financial assets grow. And that is now causing, because we got so used to that, there is no other paradigm available. So currently, bad news is good news bad economic news is good news for your investments. Crazy as this might sound. The final slide, Harry, if you can. Now, just to wrap everything up, as David alluded, in 2021, we had actually predicted the slowdown, and that was before Ukraine. And now it's playing out. In fact, it's playing out because of Ukraine worse than we thought, because central banks are way more hawkish than we originally have thought. But our portfolios, up to a point, they were prepared to deal with the slowdown and slow removal of accommodation. We are entering a recession period, make no mistake about it. I think the probability of a recession, bar a policy surprise in the UK and the US and globally, is big. But what you need to remember, recessions come and go. Bear markets are followed by bull markets. It's a cycle. As long as capitalism is a going concern, things eventually revert to the mean. And, David spoke about valuations. Things are cheaper now. For things to become attractive, we also need central banks to be helping us with a more positive outlook, or a more accommodative outlook. But when they do, what looks now expensive or less attractive or even cheap does not make me want to buy it necessarily. But if central banks give me the green light, then cheap becomes attractive, and that's when everybody goes back into the market. Again, we cannot time it. If only we could, we'd all be rich. But generally, the thinking now is that central banks are going to be hawkish for the most part of the year. And let's see what happens after the end of 2022. And with that, we can open it up to questions, I think.
Thank you very much indeed, George. We've probably got 5 or 10 minutes maybe to get through some questions. As I said, we've had quite a lot, and it won't surprise you to hear, George, that a lot of them were around inflation. I think you probably answered most of the inflationary questions in your part of the presentation, but I wonder if it's just worth a little recap, and I'll just pick one of the questions which probably highlights some of the issues. So the question is, I hear the Bank of England saying energy rises drop out of the annual figures in 12 months, so inflation will fall. That didn't happen in the 70s. What causes inflation to be sustained, and what level do you think interest rates will peak at, and when? I'll bail you out of the last part of the question to say that we don't know for all of the reasons that George has articulated. Actually putting a number on what the terminal rate is and when that hits is extremely difficult. Our best guess would probably be sometime next year the interest rate rising cycle will come to an end, and it'll probably be around somewhere around 2.5–3%. But that is, of course, George, subject to things that we don't yet know, not least labour market and energy prices, as you've already talked about.
Yes, so the current consensus is around there, 2.5% ish in the year in the UK, but between now and exactly the same time next year, visibility is very low. But what causes inflation, to answer the first part of your question, most of it is still supply side. Okay, companies were buying goods from Russia. They're not, by the way, Russia was a very big producer of, and is still a very big producer of raw materials. And this is important. Okay, they're not building microchips, which is an end product. They're building all the things that go into microchips, which means that these affect hundreds of supply chains. So this is this is the key point, and sanctions on Russia could well outlast the war itself, and no one has any idea when the war ends. So Russia is not selling to Westerners; it's selling to others, and probably the way it happens is that others are selling to Westerners, and because there is this cycle, things are a lot more expensive. I don't think we'll see major shortages. Could be the occasional. The occasional shortage here and there, but I do not think that we will see, massive shortages of goods, but we will see inflation. Or an interesting new concept, shrinkflation. Same price, smaller product.
Lovely, thank you, George. If you're a chocolate lover, you might have seen that in action already.
I am.
So let's try and connect then inflation to asset allocation choices. Question that's come in is, where should investors look to hedge against inflation? Is fixed income the most suitable option given the volatility in equity markets? I think we probably suggest possibly not, and that goes to that general theme of there will be a turning point at some point, but it's difficult to predict when.
Yes, and traditionally fixed income is not the best way to fight inflation. The problem with fixed income is that it gives you 3%, a 4%, a 5% inflation. Usually is much, when we're talking about real inflation, it's usually much higher than that. So it's the best tool, and usually traditionally when we're thinking about where to invest in times of inflation, equities are the preferable asset. And of course, you can find various alternatives, inflation-linked bonds on occasion, but these are all much smaller parts of the market. When we're talking about asset allocation, really, it's bonds, equities, and some commodities. These are the main choices we have to make.
And suffice to say, questions about whether equities or bonds are right for you depend upon your personal context, situation, and attitude to risk. And I guess the other thing to say is actually, although it is for fixed income investors a little bit of a painful period to see prices dropping, ultimately, in the long term, as a bond investor, what you want is higher interest rates, because although you might get a nice warm feeling as interest rates are falling and that gives you some capital appreciation. Ultimately, the clue's in the name, fixed income. The coupon is fixed, so you want that coupon to be fixed at as high a level as possible. So in the same way that we will see a turning point for equities when we get towards the end of this interest rate rise cycle, there will be an optimal point to buy into fixed income also. As we say, again, to repeat, because it is important, very difficult to know when that is. And on that subject, George, of turning points and rebounds, question, when do you foresee a rebound in tech stocks? I'm guessing we probably don't.
We don't really. Look, you had the Amazon used to trade at 200 times its earnings. The average of the market is 15. Finally, Amazon has a lot of clients. That super growth is not there for it anymore. Facebook has hit a plateau, and same has Netflix. Sometimes those companies grow enough. They have so many people. There are only so many possible subscribers on planet Earth. So a lot of these companies are reaching the mature stage. Some of these are actual monopolies. Some of the others, like Tesla, are facing competition. And for example, Mercedes now is actually developing a car with 3 times the autonomy of a Tesla, about 1,000 kilometers on a battery. Which means that Tesla's business model is threatened. So why would anyone pay 1,200 times its earnings when the market pays 15 for or 16 for its competitors, even less actually? So the point I'm making is that yes, there was a big tech boom, which coincided with quantitative easing. Quantitative easing is being retracted. No idea whether we're going to see a lot more of it now, just tightening. But also a lot of these companies are now hitting the more mature stage of their existence. So, for some of them, very high valuations, very rich valuations might not be in the cards. That's not a bad thing. If you have an investment, maybe you want a little bit of predictability.
Thank you, George. Let me try and squeeze in 2 final questions very quickly. One that's come through whilst we've been presenting. Can you say something on currency risk, please, especially if the pound appreciates from here? You mentioned 9% on gold. How much of that was driven through the conversion from US dollar, which of course gold is priced in? I don't have the number to hand, but I would suspect probably the vast majority of it. Gold's been up and down a little, but broadly stable year to date, and it is that US dollar appreciation which has been positive for sterling-based investors. Within our asset allocation, we try to be most of the time pretty agnostic about currency risk. In our overseas equity exposure, we hedge pretty much 50% of the currency risk for our overseas assets. And that's simply just recognizing that currency markets are by far the largest and most liquid of all the markets. And therefore, it's very difficult to take a position either side of that. Having said that, we did, as I mentioned earlier, want to have a little bit more US dollar exposure over the last couple of quarters, but we may well take that off soon. One final challenging question we had pre-submitted, and thank you for this, because it is a challenge. Do you not think you were a bit behind the curve with the change in sentiment and your reactions to it? As ever, when you get significant movements in markets, whether they are up or they are down, one can always look back in hindsight and reflect and think, I wish I'd been a little bit more skewed towards the more favorable direction. However, I think in fairness, we've been pretty consistent over the last 9-12 months in what our messaging has been and how that's been reflected in our portfolios. We had a very consistent overweight in equities for many years throughout the sort of QE period, and we took that off in October of last year because we did recognize that we were getting to a situation where monetary policy looked like it might change, and that of course was driven by this whole question about inflation, but was before we had the situation in Ukraine. We also had a very long-standing underweight in bonds. We were underweight the asset class, and we were also underweight what we call duration, i.e. the sensitivity of our holdings to interest rate rises. So that has actually protected our portfolios quite significantly as interest rates have gone up. And again, that is something we'll be revisiting fairly soon. We have also tended towards the value funds, as I mentioned earlier. Out of growth and into value was a change that we made in January, and indeed in April we had this preference for US dollar over everything else, which has paid dividends. And speaking of dividends, that was the other change that we made, was to prefer those companies that were more likely to return assets to shareholders rather than the more growthy tech sector. And then finally, we've had this overweight gold position for a couple of years now, which has benefited much more recently, because we did want to position the portfolios for periods of stress. So, would we have liked to be more underweight equities? Well, obviously yes. However, I would point to the situation in Ukraine and say that was pretty much a black swan event that couldn't really be foreseen or indeed positioned for. If there were one change that we made that I'd rather we didn't, we had an overweight in UK equities. And if you can recall one of the early slides, that UK equities have been pretty much the only good performing equity market. We took that off in April because we wanted that US dollar exposure. So we have given up a little bit of that, but obviously as UK centric investors, we still do have a good exposure to the UK. So to sum up, difficult markets to navigate, very much a very significant change in the investment landscape. No longer are we in this period of quantitative easing, easy money. There is no alternative but equities. We are back to something much more, might we say, normal. I think that's actually a positive and healthy thing for investment markets in the long term, even if it feels a little bit painful at the moment. Okay, let's leave it there. Thank you all very much for joining us this morning. It is very much appreciated that you choose to spend your time with us. The next session will be 10 a.m. on the 27th of July, and George and Harry and I very much hope that you choose to join us for that one as well. Thank you very much. Goodbye.